Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Keep calm and carry on. US futures gain as the Fed downplays the risks to growth and says the inflation impact of tariffs could be transitory. A report that Nvidia is to spend hundreds of billions on US-made chips adds to the optimism. Ukraine's president backs a halt on energy attacks after speaking to Donald Trump for the first time since their Oval Office bust-up. Talks on a wider ceasefire are set to begin in Saudi Arabia over the coming days. And Israeli ground forces retake control of Gaza's Netzarim corridor. Hamas calls the ground incursion a dangerous violation of the ceasefire agreement. A very good morning. Welcome to Thursday. And as we check on these markets, we have futures pretty flat here in Europe, but pointing higher stateside. After yesterday was the S&P's best Fed day since July. We had this dovish, relatively dovish performance from Jay Powell, as I say, using the T word when it comes to his outlook for inflation. Transitory is potentially what these Trump tariffs are going to do when it comes to the inflation outlook, and actually pouring cold water really on the recession fears as well in the US. So that boosting US stocks yesterday, and that optimism fueled today by a report overnight from the Financial Times that Nvidia is going to be investing hundreds of billions of dollars into its US outfit. And so are we going to see that translating into higher earnings? That is the question for whether these gains hold throughout the morning. But let's flip over to the cross-asset picture. You can see the impact of Powell's remarks yesterday. The 10-year yield currently at 4.24%. We did have Treasury yields dropping lower yesterday off the back of his remarks. But today, really, the focus switches over to the Bank of England and the SNB. Their decisions coming later. You've got cable at $1.29, slipping below the 1.30 mark where it had been because of Powell's dovishness, but also the expectations that the Bank of England is going to be relatively more hawkish than its global peers. Swissy there as well, 87 centime, so weaker, a tenth of 8%. And copper, interestingly, tipping above that $10,000 a tonne mark on the London Metal Exchange on these tariff threats from President Donald Trump. But let's dive into that Fed decision now. The Fed, of course, keeping its benchmark rate steady for a second straight meeting, with Chair Powell saying that the inflationary impact of President Trump's tariffs is likely to be transitory. Take a listen.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
So, Jay Powell there. Let's bring in Bloomberg's Valerie Teitel for analysis. Val, do you reckon that Powell got the market where he wanted it to be here? Pretty dovish, and yet they've boosted their inflation forecast.
Yeah, that's right, Lizzie. With their economic forecast, they boosted their inflation numbers, cut GDP growth, but didn't imply more cuts in the dot plot. Left a lot of commentators scratching their heads over what the clear message was from Powell yesterday. But the equity market had a clear message. As you mentioned, futures seem to be adding on to yesterday's gain, with the S&P 500 having its best Fed day since July. Now, a lot of this positivity in the equity market, Lizzie, was due to the fact that Powell didn't necessarily mirror this pessimism on U.S. economic growth that some economists have pointed out lately. Instead, he is still seeing that hard data still pretty solid for the U.S. economy. He even downplayed the recent drop we've had in sentiment survey data, saying it doesn't always correlate that consumer sentiment, business optimism dropping leads to lower GDP growth. He also wanted to say that in the 2025 GDP revisions, yes, they knocked it down to 1.7%, but that's still very close to the long-term trend. So the Powell really not forecasting a recession on the cards and is really in no hurry to cut interest rates at any point in the next few months. Now, that has attracted some political heat from President Donald Trump. He had a post on Truth Social just a few hours ago saying that that the Fed should cut interest rates because it would help the transition period as the U.S. economy adjusts to these tariffs that he is threatening are coming in on April 2nd.
OK, Valerie Teitel, we thank you. So as the Fed is calming these fears over tariffs, that is also feeding into the Asian session. Let's go now to Avril Hong in Singapore. Avril, you're seeing stocks rebounding where you are?
Oh, absolutely, Lizzie. For the most part, I think the Fed allaying concerns about the ultimate impact of tariffs is helping the likes of South Korea, the Taiwan gauges. Japan is closed today. And you do get some questions still swirling about how long this reprieve might last for these Asia trade-reliant economies, especially with the clock still ticking down to the April 2nd deadline. The outlier today is what we're seeing in Chinese stocks. And flip the board, just take a closer look, because this is a week where we've got a big number of tech earnings and they've been looking pretty solid. Whether you're looking back to Xiaomi or Tencent, I guess if there was one thing to kind of nitpick on, it would have been the AI capex plans of Tencent. But that being said, it also seems to be investors taking profit, maybe looking out for fresh catalysts in the market. Keep in mind as well that sources are telling Bloomberg that Hong Kong could be planning a margin loan cap of retail investors' purchases of IPO shares to kind of cool the heated retail demand. Our colleague, MLive's Mark Cranfield, points out that this might be slightly negative for the markets, but ultimately, in the longer run, maybe eventually, institutional investors could kind of step in and pick up the slack. So keep that in mind, even as we see the losses in tech in China today, down for a second day on Hang Seng Tech. Now flip the board, because that sense of relief that you got from the Fed that played out in Asia stocks also kind of being reflected in Asia currencies, where the Indonesian rupiah following a 3-day decline, some of this, of course, to do with the growth fiscal discipline concerns, is actually leading the pack in the gains today. And some of this also, I think, reflects how sensitive EM currencies have been to domestic political headlines. That's a point that Mizuho has been making, and I think that also feeds into the allure of the Japanese yen. And this is despite BOJ Governor Ueda sounding quite cautious just a day ago. The outlier for Asia currencies today is the Aussie dollar, and this is after a weak jobs number. The employment data defied expectations of a climb, and we're seeing also some bets of a May cut from the RBA picking up.
OK, Avril Hong in Singapore, we thank you. And I want to stay on that currency theme and central banks as well, because we turn now to the Bank of England, which is likely to turn less dovish later today. We're going to get a hold, economists expect, but in the commentary, perhaps a bit more hawkish. This is officials worry about global trade tensions and a renewed bout of domestic inflation. Let's speak now to Ben Ram from Bloomberg MLive. Ben, we have seen the pound climbing back above that $1.30 mark on Powell's dovishness yesterday. It's just below it again now, but we've also got the expectation really that the BOE, as I say, is going to be more hawkish than the Fed going forward. Then how much higher could the pound actually go today if they tweak the inflation outlook, for example, if they make it higher?
Well, morning, Lizzie. I don't know if the Bank of England is going to be hawkish enough to change the inflation forecast just yet, because we just got a revision in February, and that's when they set out their stall. I think the next revisions big macroeconomic revisions will come in May. So I don't think they're going to indicate much more than what they indicated in February. Having said that, there's going to be, language. We already got the language, in fact, last month about them being careful. So I don't think there's going to be any more hawkishness to a degree than we saw last month. But having said that, if you look at the pound, Lizzie, I think that the upside, the risk-reward skew, there's a risk-reward skew going into this meeting, because if you look at the pound, It's rallied, what, 7.5% since the lows of January. That is such an emphatic rally in such a short span of time. So I think that, if you look at the, it's a heavily overbought currency in the short term. So I think that there's going to be more likelihood of a correction rather than upside from here in the short term. In the medium term, because the Trump trade has been unwound, I think the dollar is going to be staying soft around current levels. And therefore, I think that the pound has got buoyancy, and I think it's going to find an equilibrium around 127 levels per the dollar.
OK, really interesting. I also wonder to what extent the market will take signals from the vote split after, of course, the governor said don't do that after the last vote split and the surprise jumbo cut from Catherine Mann, that vote really taking markets off guard. But, Ben, if we can turn as well from the monetary to the fiscal, because, of course, we've got UK Chancellor Rachel Reeves' spring statement coming next week. And when I spoke to her on Monday, she hinted that she's going to give herself more headroom than the £9.9 billion she left herself after the autumn budget. I just want to play you that bit of the conversation.
Well, we inherited from the previous government not just a big black hole in the public finances, but the lowest ever fiscal headroom. We increased that headroom in the budget last October because it is important that there is headroom against the shocks that we face. But the fiscal rules we've set are the right ones. They are a robust set of fiscal rules, but it is important that we balance day-to-day spending with tax receipts and that we get debt down as a share of GDP. Those are the right fiscal rules for the circumstances that we face. But when we're spending £100 billion a year on servicing government debt, I don't think anyone could seriously argue that we don't need to get a grip of government borrowing and government debt.
So a big hint from Rachel Reeves there. And then our Bloomberg colleagues Phil Aldrich and Joe Mays have now confirmed that she's going to rebuild that fiscal buffer at the spring statement next week. I wonder, is that going to be enough to fend off the bond vigilantes?
First of all, congratulations on that interview. I think it was a brilliant interview. The point about the fiscal headroom, Liz, is that we've got two planks of action for traders. One is the bond vigilante action, which is what we saw in early January when bonds sold off, gilts sold off heavily, although that came in sympathy with what was happening in the US Treasuries. I think that move has wound down a bit. So I think that that is good news for Rachel Reeves and the government. But the other worrying bit of news is about inflation. If you look at the two-year inflation markers, whether you look at zero-coupon inflation swaps or inflation break-evens, they're thinking that inflation in 2 years' time is going to be closer to 4%. That's twice the BOE's target. So, here's a market that thinks that the BOE is going to be missing its target for years on end, and therefore that puts upside pressure on gilt yields. And to the extent that gilt yields keep rising, that's going to corrode the headroom, regardless of the new headroom that Reeves may have found. So I think that, that is going to be an ongoing concern for the UK government. In the October OBR forecast, the OBR assumed that the average gilt yield would be 4.1% on nominals. Now, that by my estimates, that yield is now 4.63%. So we are 53 basis points higher than what the OBR outlined then. So that is definitely a big concern for the government going forward.
OK, really interesting. Well, we look ahead to that Office of Budget Responsibility forecast next week. But Bloomberg's Ben Ram from the MLive team, lovely to see you. We thank you. Now, we're going to switch focus to the other central banks coming up with decisions as well today. We have the SNB as well, the Swiss National Bank, expected to cut by 1/4 point. The BOE, as I say, expected to keep rates on hold. But we also have Sweden's Riksbank expected to hold as well. Then at 12:30 p.m. London time, we have US initial jobless claims. And later today in Brussels, we have an EU summit being hosted to discuss how they can boost their own defences without the US. So we're going to dive into that next with Bloomberg's Oliver Crook. So stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, in a call with President Trump, Ukrainian leader Volodymyr Zelenskiy has agreed to pause strikes on energy assets, echoing an agreement the US and Russia made earlier this week. US Special Envoy Steve Witkoff, meanwhile, says that he is hopeful a full ceasefire between Russia and Ukraine can be reached soon.
On Monday, we actually have the technical teams going, and why? Because that's what we're down to. We don't need to have the larger overarching discussions. That's been had, and it was completed yesterday between the two leaders. They agreed on a pathway to some ceasefire conditions today and to a full-on ceasefire that will be negotiated over the coming days. I actually think in a couple of weeks we're going to get to it.
Let's get more now with Bloomberg's Oliver Crook. Ollie, what is next here in terms of the Russia-US negotiations for a Ukraine ceasefire? I know that Trump's spoken to Zelenskiy as well as Putin, but what I want to ask you is it the case that Europe has been sidelined here?
I think it's fair to say that it's the case that Europe has been completely sidelined here, and this is very much the feeling that you get when you sort of observe these leader meetings and you sort of listen to the press conferences and you hear what the European leaders have to say. They're really sort of in reaction mode to everything that the Trump administration is doing, and they're not at this point. Now, we've been hearing from the Trump administration that at some point the Europeans will be involved in some of these discussions. At this point, they really are not, though we did hear from that conversation with Steve Witkoff yesterday that he did brief Emmanuel Macron on the phone personally after the call with President Trump, and Macron apparently, according to Witkoff, reacted sort of very positively. But really the task for European leaders today is less about sort of their sort of particular influence on Ukraine today, but basically how they're going to gain relevance going forward in terms of their defense industry, their defense build-out. And what they're going to do today is going to basically put into action, put into sort of concrete terms, the proposal that we got from Ursula von der Leyen, the European Commission president, a couple of weeks ago, the Rearm Europe plan. These are different initiatives that are going to be sort of going across the EU, so that they include a 150 billion euro loan that is going to be sort of available to the European Union member states in order to build out European defense capabilities. We should say that increasingly they're much more concerned with buying European in terms of these defense capabilities. Of course, there's a limited supply of what they can actually get from Europe, but that is part of the goal of what they're building out. They're going to potentially change the EIB, the European Investment Bank's investment mandate, so they can invest directly into defense. They're going to redirect some funds. They're going to change those fiscal rules. So that is the stuff that we heard from Ursula von der Leyen a couple of weeks ago. This is the meeting at which the European leaders will put that into actual language and make forward progress in terms of concrete measures.
OK, so you're in Brussels. You'll be across that all day for us. But meanwhile, Donald Trump's got another ask of Ukraine. He wants the US to own Ukrainian power stations as well as its rare earths, or some of them. I mean, the former UK Defence Secretary Ben Wallace was already calling the minerals deal extortion. Is this more of the same?
So listen, it will depend on your sort of perspective on the situation. If you talk to the Trump administration, you talk to some of the Trump supporters over in the United States, basically what the president needs to do is to explain why to many Americans, there's a spending hundreds of billions of dollars to support Ukraine. And this is part of the policy of trying to get value for money back for some of those, sort of investments. This is how Donald Trump sees things. Of course, from the European perspective, it's seen as a very sort of extractive policy. I mean, we got a little bit of an idea. And again, this is how Trump sort of operates. He floats an idea out, sees what the reception is. So we heard it from Caroline Leavitt, the White House press secretary, yesterday. Have a listen to what she had to say.
President Trump also discussed Ukraine's electrical supply and nuclear power plants. He said that the United States could be very helpful in running those plants with its electricity and utility expertise. American ownership of those plants would be the best protection for that infrastructure and support for Ukrainian energy infrastructure.
So helpful in running and owning, maybe not exactly the same thing. But of course, the point that the Ukrainians would make and have made and the Europeans have made is that basically there have been American economic interests within Ukraine and within Russia, and that didn't prevent a war. This is not the same thing, Lizzie, as a security guarantee.
OK, Bloomberg's Oliver Crook in Brussels across that summit for us. We thank you. Well, we're going to stay with the geopolitical theme on the programme. Israeli ground incursions resuming in Gaza, sparking fears of a return to all-out war. We'll have the latest from the Middle East next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. And let's go to the Middle East now, where Israel says it has begun a limited ground operation in Gaza after a 6-week ceasefire lapsed. The Israeli army says that troops have retaken control of part of the Netzarim corridor that divides the Gaza Strip from east to west. It follows airstrikes that the Hamas Health Ministry says has killed more than 400 Palestinians. And we can speak now to Horizon's Middle East and Africa anchor, Jumana Basechi, who joins us now for more. Jumana, are we back to square one here? Where does this leave the ceasefire talks?
Yeah, many people are saying that we are back to square one, Lizzie, and that the ceasefire, for all intents and purposes, is actually over. And this announcement overnight from Israel that they're going to start what they're calling is a focused ground operation in Gaza is just the latest in a series of developments. You will recall that on Tuesday evening, they launched a series of airstrikes that killed more than 400 Palestinians. Now, the latest is that they're going to go one step further and resume the redeployment of forces on the ground. And remember, one of the conditions of the first phase of the ceasefire was them to withdraw their troops away from populated areas towards the periphery positions on buffer zones. This has now changed. They started putting back troops back inland, and is just another indication that there are no signs of a de-escalation at that point. Israel is saying that they're going to continue pressing on until Hamas release every single hostage. It is believed that around 58 hostages are still being held with Hamas. About half of them are believed to be alive. And the defense minister also sending a final warning, quote unquote, to Palestinians, saying that unless the hostages were released, residents of Gaza would soon be evacuated again from buffer zones.
And meanwhile, Israel says it's being attacked by Yemeni missiles and Houthi rebels targeting the Tel Aviv airport. What do we know, Jumana?
Well, that's another front also. And what the Houthis have been saying over the past week is that they're going to resume attacks on vessels, on ships going through the Red Sea that are allied to Israel or to the U.S. in solidarity with the Palestinians and in the absence of a sustained ceasefire. And so the latest overnight is that around 4 a.m. local time, sirens went off in Tel Aviv because the Houthis, who later claimed responsibility, fired a ballistic missile from Yemen towards the Ben Gurion airport on the outskirts of Tel Aviv. No casualties were reported. The missile was intercepted, but is it just another manifestation of the conflict and the rising the escalation in the region, and not just between Israel and the situation in Gaza, but also between the Houthis, an Iranian proxy, and the U.S. as well, with the Trump administration sending very strong messages towards the Houthis and saying, if you continue with these attacks, we will read them as an attack by Iran. So you have to stop them immediately. And of course, the U.S. themselves launched a series of airstrikes on Yemen positions over the course of the weekend too. So yes, most definitely, we are seeing an escalation on all fronts once again in the Middle East.
OK, our Horizons Middle East and Africa anchor, Jumana Basechi, we thank you for bringing us the latest geopolitical developments there. And meanwhile, the protests in Turkey following the detention of the mayor of Istanbul on Wednesday yesterday have been roiling the Turkish markets, the lira and Turkish stocks tumbling on that move. Critics of President Erdogan saying that it reflects his increasingly aggressive campaign to silence the opposition. Now, Ekrem İmamoğlu, the most popular Turkish politician who could one day perhaps challenge the president's rule, posted on social media saying that the will of the people cannot be silenced through intimidation. And indeed, you are seeing Turkish futures dropping 0.4% at the open, now a 10% drop in those futures. So we shall keep an eye. It is not quite that big of a move. 0.4% of a drop at the open is where we are, but we shall keep an eye on the lira today. A stark reminder of the risks, really, of investing in Turkey. We'll have more on the Fed next, so do stay with us. This is Bloomberg. A very good morning. Bloomberg Daybreak Europe is here. I'm Lizzie Burden in London, and these are the stories that set your agenda. Keep calm and carry on. US futures gain as the Fed downplays the risks to growth and says that the inflation impact of tariffs could be transitory. A report that Nvidia is to spend hundreds of billions of dollars on US-made chips adds to the optimism. Ukraine's president backs a halt on energy attacks after speaking to Donald Trump for the first time since their Oval Office bust-up. Talks on a wider ceasefire are set to begin in Saudi Arabia in the coming days. And Israeli ground forces retake control of Gaza's Netzarim corridor. Hamas calls the ground incursion a dangerous violation of the ceasefire agreement. A very good morning. Welcome to Thursday. It is the 20th of March, and you're looking at futures pretty flat here in Europe, but pointing higher stateside. You have had the best Fed day yesterday for the S&P since July. This on Chair Powell's reassurances to investors that the Fed still sees room to cut this year because he says that the inflationary hit from Trump's tariffs will be brief. He even used the T word, transitory. But also you've got Wall Street optimism fueled this morning by an FT report that Nvidia is planning to spend hundreds of billions, as I say, over the coming 4 years in the US. But as we know, higher spending doesn't always translate into higher earnings, so let's just see how long those gains hold. Flipping over the board to the cross-asset picture, that dovish performance from Powell sent 10-year Treasury yields lower yesterday, and currently you're looking at 4.24% on the 10-year. Cable is at $1.29 as we look ahead to the BOE decision. And in your commodities space, I should say, some interesting moves here. Copper surging past that $10,000 a tonne mark on the London Metal Exchange on President Trump's tariff threats, and Brent there at $71 a barrel, so stronger 0.7% after a US government report really soothed concerns about near-term demand destruction, even as the Fed forecast that slowing economic growth. Well, let's dive into the oil story now. Crude, as I say, remaining below its mid-January peak with bearish factors in play, including the escalating trade war and OPEC's plans to raise output from April. But we are up for the day off the back of the Fed decision and the government report on near-term demand. Let's get more now with Carole Nakhle, who is founder and CEO at Crystol Energy. Really good to have you back on the programme, Carole. Good morning.
Good morning to you.
We've got oil up, even as the Fed has forecast slowing growth. President Trump very vocally calling for lower oil prices. That could support oil demand. What I wonder is the tariff war and its effect on demand going to outweigh the reverse factors?
That's a very good question, because you have the price effect and the income effect. Now, of course, when you are looking at prices where they are today, these are levels that we last saw primarily in 2021, when the average was around the levels that we are seeing today. But also, if I compare to exactly the same period last year, we are seeing oil prices around more than $15 lower than what we saw last year. When I look at what has changed when it comes to market fundamentals, I see primarily what we saw is the policy change. The political change. The landscape has been transformed all around the world, not just in the US, but primarily in the US with the Trump administration and President Trump. I'd like to describe him as a disruptor by excellence. Now, his policies and the sudden change with the previous administration, almost 180 degrees on many fronts, will have spillovers on both demand and primary demand, but also on the supply. And on the demand, the main unknown factor is the tariff. Now, the problem, of course, tariffs, if they were one-off, they are unlikely to make drastic changes. But here we are not able to see the end inside, because you have I slap you, you slap me back, I slap you again. This tit for tat that results in trade war. That is a big unknown today, and that by itself can negatively impact global economic growth and can more than outweigh the price effect that we are seeing today.
And when we had Trump meeting the oil bosses yesterday, Carole, I mean, he's saying that America's open for business, but I got to wonder, when there's so much downside risk for the oil price, is that really going to drive investment?
The U.S. is in a peculiar situation because it is the largest oil producer and the largest oil consumer. So the Trump administration has to achieve a delicate balancing act of keeping the consumer happy with low energy prices, which President Trump promised when he took office, and also at the same time keeping prices high enough to keep the domestic producers, the very important players, to achieve the energy dominance that President Trump wants. He wants to make sure that they are also happy. And yes, the oil industry, not only in the U.S. but also globally, received a magnificent confidence boost from the Trump administration, which is openly pro-oil and gas and also coal to a certain extent. But that is not enough. At the end, we're talking administration that is going to be in power for 4 years. 4 years is not enough when you look at the long lifespan of oil and gas investment. Investors need primarily the right price signal, and at the moment we're seeing a bearish sentiment dominating not only this year but also this year. And also they need predictability and stability and consistency in policy, not the kind of shift that we are seeing today, no matter how positive it is for the industry. It may well be short-lived. And remember, the pendulum can swing in opposite directions when you have another administration coming in power in 4 years' time.
And of course, he's also been, Carole, negotiating for a peace agreement on the Ukraine war. I wonder where that would leave the oil price and kind of to what extent it would revive oil flows, depending, of course, on what form this deal would take.
Actually, what we are seeing, some of the fluctuations we are seeing in oil prices reflect the kind of sentiment around the war in Ukraine. So, for example, yesterday, while we heard that both the Ukraine and Russia committed that they were not going to attack each other's energy infrastructure, that kind of promise fell apart quite quickly. And we saw this kind of upward pressure on prices as a result of those attacks. Still, because the negotiations have started, the people can be a little bit more optimistic that maybe we are on the way towards a peace deal. But first of all, we have to distinguish, and we can see that happening in Gaza. A ceasefire does not equate a peace deal, and a peace deal requires a much longer time to materialize, and it will take a lot of effort from both parties to make it happen and for people to commit to it. But does that mean that Russia is suddenly going to flood the market? Unlikely. Russian oil was not withdrawn from the market. We saw a redirection of international trade flow. Yes, there would be a little bit more oil coming to the market, but more importantly, there won't be supply disruptions that could justify higher prices, but not really a flooding of oil supplies into the market.
Just finally, Carole, let me ask you about the energy transition. Is it as simple as, with Trump in the White House, renewables are dead and it's back to fossil fuels?
Well, I'll give you a very brief answer. I think, yes, we might be seeing some deceleration in some part of the world, but in other parts of the world, we are still seeing the same commitment. If you bought an EV, you're not going to suddenly ditch it and go back to a conventional car. I feel when it comes to the energy transition, while people fear it has decelerated, we are not seeing U-turn, and the train has simply left the station.
OK, loud and clear. Carole Nakhle, founder and CEO of Crystol Energy. Always good to have you on the programme. Thank you. Now, let's get back to the central bank palooza of the week. Switzerland's central bank about to take another cliffhanger decision as officials wait whether to use up one of their last interest rate cuts before reaching zero. Let's head to Zurich now and Bloomberg's Bastian Benrath-Wright, who joins us with a preview. Bastian, only a few days ago, UBS was calling this decision a coin toss. So just talk us through the expectations for this decision.
Well, it's really a nail-biter because the market is pricing a 3 in 4 chance of another cut. This has been widely expected for a long time. That would take their interest rate down another 0.25% to 0.25%. However, as you said, they have very little easing space left. This would basically be their penultimate bullet before they reach zero. So we have been looking at what other indicators are doing, and the franc is down since their last decision. Inflation hasn't fallen below zero. Switzerland is battling too low inflation, but it hasn't fallen below zero yet. So the question would be they could hold. And yeah, we'll see today if they do it. The SNB has in the past certainly not been shy to royal markets. We only think about their sudden takeaway of the franc cap back in 2015, which sent currency markets spinning around the world. And also, like in this easing cycle, the decisions to hike interest rate, the that decision to hold interest rate and the decision to start cutting interest rates were all before traders anticipated them. So I would say today it is quite possible that the S&P here in Zurich will deliver another surprise.
OK, we thank you for the preview. We keep an eye on that decision. Bloomberg's Bastian Benrath-Wright in Zurich. Thank you very much. Now, later today, you can catch an interview with the SNB President, Martin Schlegel. That rate decision due at 8:30 a.m. London time. Now, to some other stories making news this morning. The EU's head of antitrust has told Bloomberg that she won't shy away from taking on Silicon Valley for fear of retaliation from the White House. Teresa Ribera was speaking to Francine Lacroix at a Bloomberg event over in Brussels.
We are not going to remain in a corner. I think that it is important that we respect ourselves when we take decisions. So this is not a decision taken because of whatever administration is in Washington or in any other country or against anyone in particular. These are decisions that are being taken because we are bound by the law, and it has taken a long time. It is based on evidence, and it is something that, as I said, intends to protect our consumers.
Ribera's comments came minutes after the EU threatened Google and Apple with hefty fines. Google's accused of breaching the bloc's Digital Markets Act by favouring in-house services and its own Play Store, while Apple has been told to loosen controls over its iPhone operating system. Staying with tech, Bloomberg has learned that Elon Musk's social network X has raised close to $1 billion in new equity from investors at a valuation in line with when Musk took it private in 2022. Sources tell us that the company is considering using some of the proceeds to pay down its remaining debt load, and that Musk himself participated in the deal. And Finland's unbroken streak as the world's happiest country has continued for an 8th straight year, while the US fell to 24th place, its lowest ever level in the global ranking. The study by the Wellbeing Research Centre at the University of Oxford is based on a 3-year average of a population's self-assessment of its quality of life. Researchers found that belief in the kindness of others is much more closely tied to happiness than previously thought. Denmark, Iceland, Sweden and the Netherlands rounded out the top 5. Don't know what I'm doing in London then. Coming up, Wall Street rallies after the Fed calms concerns on President Trump's tariffs. We're going to discuss the recent volatility with WisdomTree's Director of Macroeconomic Research, Aneeka Gupta, coming up next. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. It is 6:45 a.m. and we've got US futures pointing higher after Wall Street rallied yesterday following that Fed decision to keep rates on hold. The Fed Chair Jay Powell calming concerns about the inflationary impact of President Trump's tariffs, but also raising the inflation forecast. Let's make sense of it all now with Aneeka Gupta, who is Director of Macroeconomic Research over at WisdomTree. Always good to speak to you, Aneeka. I mean, it was finally a good day for the S&P yesterday after that decision. But I wonder, in the bigger picture, have you been agreeing with US Treasury Secretary Scott Bessent's assessment that this kind of correction is actually healthy?
I think it is a reflection, Lizzie, of what's taking place in the economy. We are seeing a weaker growth trajectory. The path to inflation remains quite bumpy, and there's plenty of uncertainty being triggered by Trump's tariff policies. So I think it is being reflected on the equity markets, which is why we've seen so much of pain. I think last night the Fed did tilt on the dovish side. He did provide a bit of, confidence that the economy so far is doing fine. And in fact, if inflation stays around these current levels, unemployment does not move that much, and real growth is still running close to 2%, then it doesn't, there wouldn't actually be a reason for rate cuts. So in a way, he did assuage those concerns on the growth narrative for the U.S. economy.
And the other reason why Wall Street futures are higher this morning, Aneeka, is this FT report overnight that Nvidia is going to inject hundreds of billions of dollars of investment into its US operation. I wonder if you share the confidence of futures this morning that this is going to power big tech, that, it's perhaps time to catch this falling knife?
I think it's hard to tell at this point, Lizzie. The announcement that we received early in the year by DeepSeek in China did provide, quite a change in the narrative for hyperscalers spending a lot more. DeepSeek is actually, bringing about the ability to democratize the use of AI. And so, we'll have to see and try to look a little bit more into the details of whether this could trigger or reinstate that rally we've been saying over the prior 2 years within the Mag 7. But, the way we're looking at it is at this point in time, investors are looking for a place for refuge within the U.S. equity market, because tariff uncertainty remains very high. And I think where investors have begun to be looking for that is within, income-related, dividend-related strategies in the U.S. economy.
OK, really interesting. So that's a place for refuge within the US market. But what about outside it? There's a lot of interest now in Europe and China. How do you weight a portfolio between those and the US?
Yeah, we now that we're seeing plenty of news on fiscal stimulus coming out from the European economy, geared towards protecting its borders, geared towards the defense sector, that has brought about a turnaround in sentiment. The possibility of a ceasefire being struck between Russia and Ukraine has also helped, reinvigorate some of those international flows that were being held on the sidelines owing to this geopolitical uncertainty. So that is changing the narrative for European equities. They've had the strongest run in 2025, and it's been predicated on easing of a monetary policy by the ECB, a turnaround in sentiment. We're seeing it reflected in the PMIs, and this new bounce of fiscal stimulus that is likely to impact the European economy on a positive way. That is clearly resulting in a strong surge of inflows for European equities.
Yeah, and I mean, on the defence angle, do you actually think that the European defence companies are going to do even better, if it were possible, than already expected, given that it seems like a lot of this fiscal injection is going to go to European defence companies, not necessarily American ones? Or are you kind of sceptical that perhaps they can't meet that demand fast enough?
What we're seeing in Europe is not just the short-term reaction by EU member states. It really does mark the beginning of a multi-year structural investment cycle. Now, the reason we believe European defense stocks are poised to benefit from this investment cycle is because Europe wants to reduce its reliance on the US. It is seeing a lot more uncertainty coming in from US policy with Trump's return to the White House. And with that intention of reducing their reliance on the US, the European market has actually drafted a framework around the European Defence Industrial Strategy, which has tangible objectives for Europe to now raise their own procurement of military armament from Europe by 50% by 2030. And that's expected to scale up to 60% by 2035. So it clearly is pointing in the direction to further military procurement from in-house as opposed to relying on external allies.
Indeed, and we'll get more news on this perhaps out of that EU summit happening in Brussels later today. Aneeka Gupta, good to talk to you as always, Director of Macroeconomic Research over at WisdomTree. We thank you. Well, we've got plenty more coming up on the programme. We'll look ahead to the UK jobs data and the Bank of England decision. So stay with us. This is Bloomberg.
There's always an unconditional possibility of a recession. The economy is strong overall and has made significant progress toward our goals over the past 2 years. When it comes to changing something in this highly uncertain environment, I think there is a level of inertia where you just say, maybe I'll stay where I am. It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us. Going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs. Surveys of households and businesses point to heightened uncertainty about the economic outlook. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas. Uncertainty around the changes and their effects on the economic outlook is high.
Easy breezy. The Fed Chair Jerome Powell there playing down the risks to the US economy as the Fed held rates again. And today we're going to be switching focus over to the Bank of England and the SNB decision. And if we look into the UK's economic challenges, here they are. The expectation being that they're going to hold rates today. The vote split 7-2, 7 to hold and 2 for a quarter-point cut. But the commentary around it really could be the most hawkish since the September meeting, because caution really has been the theme of the commentary from the Monetary Policy Committee since the last vote. We even heard from Dave Ramsden, a bellwether seen as on the committee, echoing that because of the trade uncertainty. Alan Taylor too, but even Catherine Mann, who of course last meeting went from arch hawk to arch dove, even she has emphasised the need to keep policy restrictive. And that is why they are likely to maintain the guidance from the last meeting that the path ahead is going to be careful and gradual. Careful, a new addition because of Donald Trump's trade policy and all the risks around that, but also because of the concerns about inflation expectations and second-round effects in the jobs market. Now, at the top of the hour, in just under 5 minutes' time, we're going to get the latest UK jobs data, the expectation being that there isn't going to be a lot of progress when it comes to disinflation on the wage front. But in terms of the path ahead, we're not going to get forecasts today. We're not going to get a press conference from Governor Andrew Bailey, but the expectation in markets is that you're going to have 2 more cuts this year. Now, it was after the last meeting fully priced that we would get a May cut. That's fallen down to about a 70% chance, and the expectation is that there could be quite a long gap before you get another cut after May. So we'll look out for any changes on that front today, but put it into global context. And if we flip the board, we can look at the pound. We have seen that the pound has gone above the $1.30 mark on the relative dovishness from Jay Powell. It's just slipping under that mark, but if they upgrade or hint at an upgrade to the inflation forecast, maybe we'll see it popping back above that level today. Later on today, you're going to catch an interview with the Swiss National Bank President Martin Schlegel. Its latest rate decision due at 8:30 a.m. London time, and they're going to take you through all of this next on the opening trade. Guy Johnson and Anna Edwards are up next, so stay with us. This is Bloomberg.